Global Business Report here on Arise. We're going to talk oil and gas. I'm excited. We've been talking before he even came on air. Arise business analyst Chika Mbonu. Remember, Chika Mbonu is a banking analyst. He is an aviation analyst. He is an oil and gas analyst. So we're going to talk oil and gas today. Let's put it back on the screen. We had the Oando figures for unaudited financials half year 2026. You can see a 2.1 trillion naira revenue there, 20% growth. Average production 42,789 oil equivalent barrels per day, 16% jump there. And look at that average realized oil price, $79.22, 19% from the first half year of 2025. Tax credit of 100 billion, profit after tax 67. All right, business analyst Chika Mbonu is with us. Welcome, sir.
How are you today?
I'm fine. Thank you for joining us.
Good.
It's a pleasure to have you.
Yeah. You know, when we teach financial statements,
yes,
we'll say that there's so many users of financial statements, and each user will look at the financial statements from their own perspective.
Yes.
And you also heard me say, especially when I analyze the central bank financials.
Of course.
I said, you know, a very good analyst doesn't just jump into the absolute figures.
Yeah.
You always try to look at the story
behind the numbers.
Behind the numbers.
Yeah.
And it's not static. You know, for a company like Oando, who we want to look at now, there's a story, there's a trajectory behind the figures. I mean, you have done some work already on it yesterday. Talked about
yes.
the revenues that grew by about 20%.
Then
average production grew by about 16%. And then, of course, revenues, profit after tax grew by 7.5%. And then they had a tax credit of 101 billion, which we spent some time talking about.
Yes.
You know, but I mean, for me as an analyst,
yeah,
you know, that's not the aspect, you know, that I want to look at the story behind the figure. And one the story transcends half year 2026. It started a long time ago. You know, remember, Oando has spent a lot of time in the downstream sector, and downstream sector they recognize had low margins.
Yeah.
And during that period, they accumulated so much debt. And strategically, in September 2023, they realized that, you know, the business was better for them to move to the upstream.
Right.
And that was principally when the Nigerian Ajip Oil acquisition.
And you talked about that. You came on there to talk about that.
And it was August 2024,
That's
really,
right,
that they took operational control of the assets of that. So what I want to look at is not just the figures, but the issue that what do I see in the result on this journey? I see better production, better execution, lower costs, higher cash generation, and then better assets and better future opportunity. And in a few minutes that we're together, I'm just going to look through them.
Okay.
And the acquisition, what did you do for them? You know, what I just say, the half year 2026 that we're analyzing is actually where the investment is beginning to deliver results.
Returns,
returns. You know, so the now acquisition changed a lot of things for Oando. Remember, I said they were down there in the downstream, you know, low margins, and accumulated so much debt, and now they moved on to this upstream. So the acquisition gave them larger reserves, you know, higher production, bigger infrastructure, operatorship. Before they were just a participant, you know, but now they are wholly moved from 20 to 40% in the OML 60 to 63, and then they are then operating. They're the landlord of that, and better control and larger growth. So operating them efficiently is even more what is more important to them now. You know that, you know. So the biggest story, as you already mentioned there, is the fact that production of crude went up by 19%, gas went up by 14%, and then natural gas liquids went up by 28%.
Yeah.
So the physical production, really, not accounting entries, is driving the story of Oando.
Okay.
You know, and that's what I see. And then, why did the production increase? Was it magical? You know, no, you know. So 2 new wells were really completed. 12 shut-in wells were restored. 4 wells in active drilling cycle. 7 well development programs, and approximately 100 rigless interventions. These are production intention things they did. So this is operational excellence, I say, in action. You know.
Okay.
And then on operational excellence, routes, uptime went from 85% to 92%. That's massive for the oil and gas industry. And then, again, important, which is the things we're looking for, because in the 2025 half year, you know, they did very well, but they ate a little. in the gross profit. But here now, the production cost has come down by 18% to 16.83 in a barrel of oil equivalent. Okay, so you have more barrels now, lower cost, and better margins for them.
Yeah.
The other thing I see is financial performance. Of course, you already said it. Revenues went up by 20%.
Yes.
Gross profit 331%. That's, so they're sweating more now from the revenues they're making.
Yeah.
They're sweating more. It tells you more that they're spreading the assets, using the asset a little more now, because they're producing more from the assets they have compared to before. The loss from operating profit before, before they had 2025, they went into operating profit. And of course, cash generation turned positive.
Well, okay. Well,
go ahead, say.
Well, I mean, but what we looked at was the operating profits of, what was it, 128 billion. There was a 58 billion write back. Which is good because initially
but it went off the business. Yeah,
exactly. Their customers are not paying them back.
It didn't land from the moon.
Exactly. So that's
it didn't come from the moon.
Yeah.
Every entry that was the day before that comes into as a credit now is for the company.
Right.
That's the way you're going to look at it.
Yeah.
Now, of course, the issue of the tax staff credit of 101 billion.
Yes, I will also,
But that should not overshadow the fact that you have better production, better operating performance, as I showed you, cost efficiency. So the operating engine is clearly getting stronger. That's what I see for Oando.
I see you are taking I see the view you are taking. It's a long-term, it's a journey. You've always said that every time you've been on there.
It's a journey.
Fair enough.
It's a journey. But you see, the real challenge for them, as you said, before we came on program, is the 161 billion finance costs.
Yes.
About 2.7 trillion in debt.
Yeah.
And a lot of these things came historically. So this is not about production. It's not about operation. It's the debt they're carrying.
Right.
So most of the value created by the wealth is still being consumed by interest expense. So the net transformation for Oando must be financial.
Right.
Must be financial. Must be financial for them. So, but the operating cash flow swung positively to about 45 billion, profit. But with more cash, it means drilling can progress. They can invest. They can grow. They reduce debt and create value. I'm pushing to and something.
Okay.
Gas also is a good story for them.
Of course.
Gas production continues to expand, and they got involved in the Bayelsa IPP gas supply and better gas monetization and growing domestic energy business. So gas becoming one of Oando's strongest long-term growth engines.
Well, we're a gas country. Nigeria has massive gas reserves, so that should be...
The growth pipeline for them, as I see, is end of the year 2026, 50,000 barrels. Like I tell you, all those Nigerian problems, if we can get to 2 million barrels a day, most of our problems are solved. The others, a lot of problems being solved. All the debt, the other issues they have, if they can push to their plan of targets, barrel of oil equivalent of per day, of about 50,000 barrels per day, 2025, and a near long-term ambition of 100,000 barrels a day. That is that. So what I see is it supported? They have 62 development wells in process. They have 55 planned well interventions. So management has provided investors with a visible production roadmap. So the issue is execution. The other is also expanding regionally. Angola, they did Angola. They have 45% interest. And this creates a future optionality beyond Nigeria for them. So a sign of long-term expansion.
Footprint.
Yes.
Okay.
Now, the major issue, again, is strengthening the balance sheet. We thought about it already. The balance sheet has been very weak. So they have to strengthen it. They are in the process of this 200 billion rights issue. I'm sure you know that. Waiting for SEC approval. 1.5 billion capital program, dollars capital program, and of course debt restructuring. So with lower debt, interest will be lower, and then there's also higher shareholder value, which is what everybody is looking for. So let me keep zoning in. The little time we have, there are three things that will determine Oando's future. Fair enough. One is deliver on the production growth. Two is reduce finance costs. And three is a good capital raising successfully.
Yes, that's a spot.
Everything else revolves around these three priorities for me. So what is my balance scorecard for them? I'll do that now. Higher production, positive. Higher revenue, positive. Better margins, positive. Better positive operating profit. Better cash generation. Strong drilling activity. And low production costs. Those are positives. Now, what are the watch points? Higher debts, finance costs, execution risk, and oil price volatility. We say when oil sneezes,
when Nigeria catches a cold.
So what does it mean? Potential for shareholders, there's a potential long-term upside for them. For Nigeria, higher production, higher gas supply, more FX, more jobs. And for employees, more drilling activities. That's what I see.
Okay.
So everyone benefits if execution continues. So Oando is no longer merely integrating assets. That phase has passed.
They are now...
It's beginning to unlock their value. And the company has moved from acquisition and integration to operational delivery. That's what I believe the half year showed. And so the credits experience reported profit, but the real honor story is the production is rising, wells are being restored, new wells are being drilled, costs are falling, cash generation is improving, and management is laying the foundation for sustainable long-term value creation. And the wells are beginning to work. Now the balance sheet must catch up. That's my summary for Oando. And I believe that if the management focuses on execution, remember the three things I mentioned, the production are going up, capital raising success, and the debts coming down. Those are critical for Oando in the next levels.
Okay, so we should be also looking at the SEC approving the rights issue. That's what,
very critical for them to reduce the debt level and reduce the interest expense. Provide more liquidity for them, replace debt with equity, and then give them a breath of fresh air to enable them move to that.
So it's a journey.
It's a journey. As I told you before, it's a journey. Just like most companies, it's a phase for them. I have a feeling that in the next shortest possible time, the balance sheet will be restructured. If they were able to succeed in their rights issue, the balance sheet will really be made a little more flexible and more malleable, and interest expenses will come down. They have more liquidity to expand their programs. That's what I see. Because 2026 for the rest of the year, they have a capex of 90 to 100 million they want to deploy in the short cycle. And that's all investment towards pushing production.
So the wells and so on.
And the wells and so on, yes. And the optimization initiatives, when things like this happen, initially carry out the costs, double expenditure, double human resources, double CFO. Now they're getting the benefits of the acquisition, and then costs are reducing gradually.
It's an optimistic outlook on them. You've laid it out, so it's for us now to just monitor and see the milestones and see.
Just remember the three things I mentioned.
The journey.
Yes, thank you.
All right, business analyst Chika Mbonu, again, aviation, oil and gas, banking. What do you not analyze? Thank you so much for joining us. Appreciate your time.